We have the Fed minutes coming out just moments ago. Among the headlines today, officials saying that the central bank's current policy stance will, quote, remain appropriate for a time. Joining us now with more on this is Brian Cheung. And Brian, you were going through these headlines today. Anything that stands out to you in terms of what we learned from these Fed minutes?
Well, this is a relatively uneventful round of FOMC minutes for a relatively uneventful FOMC meeting. As you'll recall, January 29, they held rates steady between the range of 1.5 and 1.75%. They didn't announce anything new, particularly on their balance sheet, and they did make a slight tweak to the interest that they pay on excess reserves, which is just a mechanism for them to transmit their aspirational interest rates into the market. But the minutes saying that the participants, again, the voting members of the FOMC, saw that they needed time for a fuller assessment of the ongoing effects of the 75 basis points of collective cuts that they delivered last year. And they did mention, as you just said, that they want to keep the current policy at least for a time is the language that they use. So interpretation, they're going to be on hold. They're going to be on pat with interest rates where they are right now, at least for some short time. The other thing that's worth watching is obviously the coronavirus. That was a development that they did see kind of in the beginning of I guess, their assessment period. Keep in mind that at the time, the virus, I guess, had not really spread to the degree that it's spread today. But it was still something that they flagged policymakers saying that that it warranted close watching, but didn't necessarily say that there were any sort of immediate implications to monetary policy, at least in the short term. So again, it seems like the FOMC minutes just saying, at least for right now, Fed officials don't see any sort of pressure to change rates where they are right now.
What's interesting now is that the one headline coming out saying that it seems like it's more than just Fed Chair Jerome Powell and also Neil Kashkari, just in terms of the fact that, quote, many Fed officials see signs that the economy is not at full employment, and then what that could mean in terms of future monetary policy as well.
Yeah, well, the employment bit is really interesting because that has been a changing narrative for the Fed to actually provide the accommodation that it did last year. When you consider that basically in 2015, 2016, the Federal Reserve and Fed officials, including Jay Powell at the time, who was a governor, they all argued that the U.S. economy was basically at full employment. And if the Fed was hitting that goal, this was okay for them to start raising rates, which they did through that time period. But there's been a reversal ever since the Fed started cutting rates. And they said, look, it's blown through, speaking to the unemployment rate, it's blown through our estimates for where we thought was the bottom. In 2016, it was 5%. People were saying, this is the bottom. We cannot get deeper than 5%. You look at the unemployment rate right now, 3.6%. It's been as low as 3.5%. So I think Fed policymakers saying we don't know where the bottom is. This is continuing through the FOMC minutes that we've seen so far with the labor market gains that we've seen with job report after job report after job report. It seems like Fed officials say, well, why can't we just keep this accommodative policy stance and just see where the labor market goes?
All right, Brian Cheung, thank you.
Hey, investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.